Warren Buffett would happily spend $1 billion a year on marketing. $1 billion for a single business unit. Most CEOs obsess over cutting marketing costs. Buffett, he's searching for ways to spend more. But here's the twist. This isn't reckless spending. It's the most profitable investment Berkshire ever made. Because when you understand the business model Buffett built, aggressive spending becomes free money. Today, you'll discover the three-layer architecture that turned $20 million in 1967 into $25 billion by 1999. The holy grail business structure that prints cash while spending aggressively. Comment right now. Would you spend $1 billion on marketing if you knew the math worked? Let me show you what most investors completely missed about Buffett. Everyone focuses on his stock picks, Coca-Cola, Apple, American Express. But the real secret? The business architecture underneath. The operating companies that generate permanent capital Buffett can invest anywhere, anytime, at zero cost. In 1999, while Buffett's stock portfolio disappointed, his operating businesses were building something extraordinary. GEICO went from 2.3 million policies to 4.3 million in 4 years. Marketing spend increased 7 times. Profit-sharing bonuses hit 28.4% of salary. This wasn't growth for growth's sake. This was engineered compounding. Here's what 95% of investors don't understand about business quality. They see a company spending heavily on growth and think it's burning cash irresponsibly. High marketing costs? Red flag. Aggressive expansion? Dangerous. They want profitable businesses that minimize spending and maximize reported earnings. But this backwards thinking misses the entire point. The best businesses can spend aggressively on growth today and still generate massive cash tomorrow because their unit economics are superior. They're not burning money. They're investing at returns that would make any investor jealous. The amateur sees marketing expense and worries. The professional sees customer acquisition cost versus lifetime value and calculates the return on investment. One thinks like an accountant, the other thinks like a business owner. Buffett stated it explicitly in his 1999 letter. Quote, "We would happily commit $1 billion annually to marketing if we knew we could handle the business smoothly and if we expected the last dollar spent to produce new business at an attractive cost." End quote. $1 billion on marketing for GEICO alone. This reveals the three-layer architecture that separates wealth compounding machines from mediocre businesses. Think of it like building a building that defies gravity. The foundation must be permanent capital at zero or negative cost. Float. The structure must have superior unit economics that allow aggressive scaling. Every dollar in returns more than a dollar out. And the cornerstone must be owner-operator management with skin in the game. Character that makes decade-long decisions. Build all three layers correctly, and you create what Buffett calls an economic castle with a wide moat. Miss any layer, and the building collapses on its own weight. Let me show you exactly how each layer works. Layer number 1, the foundation, permanent capital at zero cost. This is the holy grail of business models. Most businesses borrow money at 5 to 10% interest and hope to earn more than their cost of capital. Buffett found a way to get paid to borrow billions. Pay close attention. This changes everything. Float is money you hold but don't own. In insurance, you collect premiums today and pay claims later, sometimes years later. During that gap, you invest the money. If you're disciplined in underwriting, meaning you don't underprice insurance just to grow, you can write policies at break-even or even a profit. Now you have permanent capital at zero or negative cost. Think of it like building on bedrock instead of sand. The foundation is permanent. It doesn't shift. It doesn't demand repayment. And if you're exceptional, it actually pays you to use it. Here's the trap that destroys most insurance companies and most investors who buy them. They see float as free money and chase growth at any price. They underprice insurance to gain market share, figuring the float makes up for underwriting losses. We'll collect premiums, invest at 10%, and who cares if we lose 5% on underwriting, we're still up 5%. Except what happens when investment returns fall, or when claims come in higher than expected? Suddenly, your free float costs 15%. You're borrowing expensive money and calling it a business model. The amateur sees float and thinks automatic advantage. The professional knows float is only valuable if your cost of float stays below market rates for capital. Discipline in underwriting is everything. Buffett built the solution through one person, and what he said about this manager reveals the entire secret. Ajit Jain. Buffett wrote that Ajit possesses a rare combination of talents. Quote, the intelligence to properly rate most risks, the realism to forget about those he can't evaluate, the courage to write huge policies when the premium is appropriate, and the discipline to reject even the smallest risk when the premium is inadequate. End quote. That last part, discipline to reject business, is what 99% of managers can't do. They're measured on growth. They're rewarded for premium volume. Turning down business kills bonuses. But Ajit built $6.3 billion of float while running an underwriting profit. Negative cost of float. He was paid to hold other people's money. Let me show you the compounding power. These numbers are staggering. 1967, Berkshire's insurance float was $20 million. 1977, $171 million. 1987, $1.5 billion. 1999, $25.3 billion. That's more than a 1,000-fold increase in 32 years. And through 1998, Berkshire had achieved this with a cumulative underwriting profit, negative cost of float over 3 decades. Even in 1999, with a poor underwriting year at General Re, float cost was 5.8%, still reasonable for permanent capital. Here's what this meant practically. Buffett had $25 billion to invest in Coca-Cola, American Express, stocks, bonds, whatever he wanted, and his cost of capital was near zero. Every competitor was paying 5 to 10% to borrow money. Buffett was getting paid to use it. This is why insurance became Berkshire's foundation. Not because insurance is inherently great. Most insurance companies destroy value. But because, done with perfect discipline, insurance generates free fuel for the compounding machine. But here's the critical point. Float is only valuable if you have somewhere profitable to deploy it. That brings us to the second layer, the structural integrity that determines whether you can actually scale profitably. Layer number 2, structural integrity, unit economics that support aggressive growth. Most businesses can't scale. They grow revenue, but margins compress because their unit economics are mediocre. The best businesses have structural advantages that get stronger as they grow larger. This is where GEICO becomes the perfect case study. Unit economics means what does it cost to acquire a customer and what profit do they generate over their lifetime. If customer lifetime value is $5,000 and acquisition cost is $1,000, you have a 5-to-1 ratio. You can spend aggressively on marketing because every dollar returns 5. GEICO's structural advantage. Operating costs for servicing existing customers were 20 percentage points below major competitors. This meant GEICO could spend more acquiring customers and still be profitable, while competitors couldn't match that spending without losing money. Here's what destroys most growth businesses. They confuse revenue growth with value creation. They see customer count increasing and think they're winning. But if customer acquisition cost is rising faster than customer lifetime value, they're building a house of cards. Every new customer makes them poorer, not richer. This happened to countless .com companies in 1999. Pets.com spent $300 acquiring customers who generated $50 in lifetime profit. Growth looked impressive. Revenue was soaring. Unit economics were catastrophic. The amateur asks, are we growing? The professional asks, what's our return on the last dollar we spent on growth? If that return is declining, growth is actually destroying value. Buffett and Tony Nicely engineered GEICO's growth with surgical precision, and the numbers prove it. From 1995 to 1999, marketing spend increased from $33 million to $242 million, more than 7 times. Telephone counselors grew from 652 to 2,631. But here's what separated this from reckless spending. GEICO's closure ratio, the percentage of inquiries converted to sales, steadily improved. Even as they spent more and competitors matched their advertising, GEICO converted prospects to customers more efficiently. Why? Superior unit economics. Lower servicing costs meant they could offer better prices. Better prices meant higher conversion. Higher conversion meant the last dollar spent on marketing still produced attractive returns. Buffett's rule: spend aggressively only when the last dollar spent returns a profit. Let me show you the growth curve. This is what superior unit economics produces. 1993, 2 million policies in force. 1994, 2.1 million. Steady growth. Then Berkshire acquired GEICO in 1996, and the accelerator hit the floor. 1996, 2.5 million policies in force. 1997, 2.9 million. 1998, 3.6 million. 1999, 4.3 million. In that final year alone, GEICO added 766,000 new policies, more than it had added in any previous year. And here's the critical part. While growing this aggressively, GEICO generated $590 million in cash from operating earnings and float increase. Growing fast and generating cash. This is what superior unit economics looks like. Most companies must choose, grow or be profitable. GEICO did both because its cost structure gave it a permanent advantage over competitors. Market share went from 2.7% to 4.1% in 3 years, and Buffett said they were just starting. But aggressive spending and superior economics mean nothing if management is optimizing for the wrong goals. That brings us to the cornerstone, the character that holds the entire structure together. Layer number 3, the cornerstone. Owner-operators with skin in the game. You can have perfect business economics, but if management has no personal wealth at risk, they'll make quarter-to-quarter decisions that destroy long-term value. Character is the cornerstone that makes everything else work. This next story is one of the most remarkable in business history. Owner-operators are managers who've already made their fortune in the business, have massive personal wealth invested, and work because they love the craft, not because they need the paycheck. No employment contracts, no golden parachutes, just pure commitment to building something great for decades. Think of it like master craftsmen who own the workshop. They make decade-long decisions because they plan to hand the business to their children. Hired executives rotate every 3 years, optimizing for whatever gets them promoted. Completely different mentality. Here's how most investors evaluate management. They read the bio and look at credentials. Harvard MBA, check. 20 years Fortune 500 experience, check. Stock options worth $50 million if the stock hits the target, check. They think this person is incentivized to perform. But options aren't skin in the game. Options are free lottery tickets. If the stock soars, the executive makes millions. If it crashes, they lose nothing. It wasn't their money to begin with. Heads they win big, tails they break even.
Real skin in the game means your personal net worth rises or falls with shareholder outcomes. Not options, not phantom stock. Real money you could lose. The amateur trusts credentials. The professional asks, how much of their own wealth is at risk here? Buffett found the ultimate test of owner-operator character, and you won't believe what this manager did. Bill Child ran R.C. Willey, the dominant furniture retailer in Utah. He'd already sold to Berkshire in '95 and made his fortune. He wanted to expand to Boise, Idaho, but maintain the company's no Sunday opening policy for religious reasons. Buffett was skeptical. How do you compete when you're closed on the biggest shopping day? Bill's response? I'll personally finance the entire $9 million store. If it succeeds, I sell it to you at my cost with zero interest on my capital. If it fails because of my religious principles, I absorb the full loss. You owe nothing. $9 million. Personal money. Zero compensation if successful, full loss if unsuccessful. This story gets better. The outcome reveals everything about character-driven business. The Boise store opened in August '99. Immediate massive success. Bill Child had been right. Even closed Sundays, superior service and selection won. So Bill sold the property to Berkshire at exact cost. No markup, no thank you premium, no interest charge on the 2 years he had capital tied up. Just integrity. Buffett wrote, quote, "If a manager has behaved similarly at some other public corporation, I haven't heard about it." End quote. Think about what this reveals. Bill Child was independently wealthy. He didn't need Buffett's approval. He didn't need the income. But he risked $9 million of personal wealth to protect a principle and prove a business concept. That's the owner-operator mentality. They're not managing other people's money cautiously, they're investing their own money boldly when they believe in something and bearing the consequences personally. This is the character that builds businesses worth 15 to 20 times their balance sheet value. These 3 layers, float foundation, unit economic structure, and owner-operator cornerstone, create Buffett's economic castle. But maintaining the castle requires one more discipline: ruthless capital allocation. Knowing when not to build. Let's bring this 3-layer architecture together, because each layer depends on the others. Start with the foundation, float. Permanent capital at 0 or negative cost. This gives you fuel for the compounding machine. Build the structure, superior unit economics. This determines whether you can deploy that capital profitably at scale. GEICO could spend $1 billion on marketing because every dollar returned more than $1. Place the cornerstone, owner-operator character. This ensures management makes decade-long decisions that widen the gap between book value and intrinsic value. Bill Child risking $9 million of personal wealth, that's the mentality that builds enduring value. But here's what makes this truly powerful. Each layer compounds the others. Float is valuable if you have great unit economics scale if you have owner-operators who won't sacrifice them for short-term growth. Character matters if there's actually a great business to protect. Now let me show you what happens when one layer fails, even if the others are perfect. Buffett acquired Dexter Shoes in '93. Great management. He praised their skills, energy, and devotion. Seemingly good business, profitable, growing, market position. But Dexter manufactured shoes in the U.S. when 93% of shoes sold in America came from abroad with extremely low-cost labor. The structural advantage disappeared. No amount of great management could overcome $20 per hour Maine labor competing with $2 per hour Vietnamese labor. Dexter went to zero. He later called it his worst investment ever because he paid $433 million in Berkshire stock. That stock is worth $25 billion today. The real cost? $25 billion in opportunity cost. The lesson? Great management and great character can't save a business with eroding unit economics. Know when the structure is failing and exit before you compound the mistake.
Here's your homework, and this determines whether you build wealth or step on landmines. For every stock you own, audit the architecture. Foundation. Does this business generate float or float-like permanent capital? Subscription revenue, negative cash conversion cycle, or does it constantly need external financing? Structure. Are unit economics stable or improving? Can they spend aggressively on growth and still generate cash, or do margins compress as they scale? Cornerstone. Does management have massive skin in the game? Founder-led with 10% plus ownership, or hired executives with option packages and 3-year tenures? If any layer is weak, ask yourself, why do I own this? Here's your challenge for the next 24 hours. Pick 3 stocks in your portfolio, run the 3-layer audit: float or permanent capital, superior unit economics, owner-operator management. Don't just watch this and do nothing. Buffett spent 32 years building this architecture at Berkshire, growing float from 20 million to 25 billion, engineering GEICO's unit economics, partnering with people like Bill Child who risk personal wealth for principles. You just learned the blueprint in 13 minutes. The question, will you use it? Read the GEICO section and the insurance economics explanation. It's a masterclass in business architecture. And if you want to see how Buffett identifies businesses with pricing power and economic moats, the defensive side of this framework, watch this video next where I break down his circle of competence system. If this changed how you evaluate business quality, hit that like button. Subscribe for more deep dives into legendary investor frameworks that separate compounding wealth from value traps. Comment below, which layer is hardest for you to evaluate? Float, unit economics, or character? I read every response, and I'll answer questions in the Community tab. Remember, this video is for educational purposes only, not investment advice. Buffett strategies require deep business analysis, patience, and discipline. The GEICO and R.C. Willey stories are specific cases that may not apply to every situation. Always conduct thorough research and consult a financial advisor before making investment decisions. Past performance doesn't guarantee future results.